All right, if we're all ready, we can call the meeting to order. The first item of business is just the roll call. Ms. Porter will go ahead with that.
Yes, good morning. All right, Landon Moore,
Here.
Mark Gardner,
Here.
Stephanie Elliott Williams, David Holly,
Here.
Karen Savage,
Here.
Mimi Terry, Derek Challenger,
Here.
Maria Taylor,
Here.
Gregory Coleman,
Here.
Tom Shanley, and he is here. Hi.
I'm here. Good morning.
Good morning. Brian Birnbaum,
Here.
Jim Whitman.
Here.
And we have a quorum.
Yes, we do.
All right. Has everyone had a chance to review the minutes? I think they were sent over last week. Do you have any comments?
And I have a copy of the minutes if anyone needs them. You can print them out. Did you need them? Yes, ma'am. Did did you want a copy?
I move for approval of the minutes.
Second.
All in favor of approving the minutes? Any nays? Minutes are approved. The next item on the agenda is just a review of the OPEB trust. Ms. Taylor is going to take us through that.
Okay, and Flora couldn't be here, she's out of town, but the figure she gave me was $8,279,246.11. Any further updates will be provided at the next meeting.
Okay. That is fine.
Hey, Landon, good morning. Can you hear me okay?
Yep.
Hey, before we go into, I'm assuming you're getting ready to transition into new business, correct?
Yes.
But before we do that, do you mind if I just introduce a couple of people that are on our side?
Sure, go ahead.
All right, thank you. So, and good morning, everybody. This is awesome that this new multi-virtual in-live situation is working well. So appreciate the opportunity and the flexibility of the board here for some of us to attend virtually as we move forward. I look forward to being with you guys probably at the next meeting. But I did just want to quickly introduce two people. So I'm actually traveling this week and visiting some of the other clients that I work with. And joining with me is Colette Sagar, and Colette oversees the Southeast region. So she wanted to jump in and have the opportunity just to quickly introduce herself and to sit in and listen in the meeting.
Hey everyone, Colette Sagar. I'm the Divisional Vice President at John Hancock. I'm in charge of just making sure everybody's happy and the services we're providing to you are great. I know you're in great hands with John as well as Tom. So if there's ever anything I can do, I'll make sure Tom gets you my contact information after this meeting. But thanks for letting me sit in today. I appreciate it.
Thanks, Colette. And as Colette mentioned, also joining us today is John Morrison. I know as I communicated to the board recently, Andre Stewart, who'd worked with the city for a significant amount of time, moved on to take on a new opportunity. So John is joining us and now has responsibility for actuarial services for the city. And just wanted to give John a quick opportunity to intro himself, and he'll also be joining me in the near future to come out and meet you guys in person. John?
Yep. Thanks, Tom. I think Tom said pretty much everything I wanted to say, so I'll be taking over for Andre. I joined John Hancock a little bit earlier this year from another actuarial firm where I have over 15 years of pension experience. I've been working with Tom and the team to get up to speed And I know that we'll have a meeting with you all sometime later in the late fall, early winter. So I look forward to working with you all and meeting you all in person in a few months.
Thanks, John. Thanks, Landon. Appreciate the couple of minutes.
Yeah, thanks, Tom. Good meeting you, Colette and John.
Meet you.
Okay, so Ms. Porter has an update on the boards, commissions, authorities, and committees manual.
Yes. Actually, I was just passing along the updates Patty Phillips created. I put them at your place settings. I didn't know if anyone wanted to add to those corrections, but I want to pass this to the city clerk today if I can.
And does this need to be voted on?
No, it's not. And Derek, I want to defer to you because I don't know if this is a legal document.
No, this is just an informational manual for the city boards, commissions, authorities, and committees. So this is something that can be done by staff without voting. It doesn't impact the actual plan itself.
Okay, so this is just for our information.
Right.
I looked at this, last week, and I'm fine with it, even though I don't have to vote.
Okay.
Or I don't have any comments or concerns.
Sure.
Are we at a full 9 membership on the board?
No.
Okay.
As far as I think we just had 2 people drop off the board, Joel Hawkins and Danny Covey.
Okay.
But even prior to that, I think we were down a couple people, weren't we?
Mm-hmm.
So we need. There's the 5 of us. We need 4 additional members.
Need a representative from the police department and the fire department.
So, is it supposed to be an active member of the police department and fire department? Because soon we're not going to have any.
I think it's a preference for an active fire and police, but I think the next best thing is a retired police or fire because they still have an interest in those particular funds. So I think but obviously at some point it may be difficult to get either one. So I think that's a preference. It's not an absolute. Because at some point it may be not possible or feasible. Even with
They'll be in their 80s.
What's wrong with that?
Nothing.
Derek, something to consider then is the changes. The changes here say that they need to be an employee of the fire or an employee of the police department.
Yeah.
Does it say need to be or should be?
Shall be.
Shall be.
But at some point it may be an absolute impossibility.
Yeah. So, while you're making changes to the manual, do we want to make a change to that so that it could be either an employee or a retiree of the system?
You have to look to see whether or not that's actually in the code. Because if it's actually in the code, then city council would have to be involved in making a change to the code. And that's one of the issues with having a commission that very few active members. And so yes, that's a consideration that we may want to look at in the future, but it's not as simple as us making a change.
So at this point, should we, I'm not sure who has sort of the relationships with the fire and police, but has someone at this point reached out to them to see if there are any sort of volunteers? Or a plan to?
I'm not sure. I know that's generally a clerk's function in terms of determining or being a liaison for new members as it relates to council. So that's something I can bring up to the city clerk.
And then,
Sorry, we're going to have trouble reaching a quorum. We've had several meetings where we have not had a quorum. So we need to reach out to them pretty quickly.
Sure.
We made
Do
it
we
by
want to
1
hold off
today.
on the changes until perhaps Derek helps us coordinate?
I don't think we have to hold off on that
Are
change.
you good? Okay,
Yeah.
okay.
So, I mean, to me, I mean, if this is just a sort of internal staff document, you can just change it again if you need
Okay,
to.
We'll do that. All right, we'll go ahead with this then. You want to do that? Okay. I'll get that to the city clerk then.
And then if you gotta change the actual code, then that's a whole nother.
Out of curiosity, does the city have somebody recruiting for boards like this, or is it, who recruits?
That will be with city clerk's office. And I could certainly ask her specifically about this board to see if they are actively recruiting.
Right.
I could do that for us.
Because I don't think it would be tough to call either the police chief or the fire chief and ask them if they have somebody that would be good on this board.
Okay, gotcha.
Yeah.
Okay.
Tell someone to volunteer.
Be helpful for your future.
And you know, at least David, Mark, and I think have been on this board for a while.
Yeah.
I mean, I'll say I don't plan on being on this board forever. So, you know, it'd be good to get some new members before we have additional members drop.
It's always good to get new blood, I think, you know.
Okay. Okay, I'll follow up with everyone on that. I'll get with the city clerk. I'll see what I can find out.
And then we'll have the whole table full.
Yes. All right, Kristen, I'm gonna go ahead and do that.
All right, so the next item is Greystone doing a portfolio review. Welcome back.
Thank you. Before we begin, I know we're trying to keep this environmentally friendly and reduce handouts, but a transition like that can take some time. So we do have 4 or 5 hard copies for those that might prefer a hard copy. Anybody would like a hard copy? Otherwise, we'll just present
You're
it.
planning on putting it on the...
We will. Yeah.
I mean, I will take a hard copy since you have it, but I'm fine moving forward to not have one. Because if I don't take the hard copy, then you're really wasting it.
We'll take it back.
So then at least it'll be looked at. And it'll make your suitcase lighter.
One more. Indeed.
Those, you-
65 page of 64 pages. So, thank you.
well, that's sort of by your choice how many pages there are.
Yes.
Yeah, indeed it is.
Probably 10 pages of disclosures.
Yeah.
Well, as
You make
too many numbers.
was it Mark?
Yeah.
You make Mark carry the books?
He did. As Stacy is bringing up the file, it's great to be here with everybody in person. I know the technology is great and convenient, but it's always nice to be together. So we're delighted to be here. Just a quick introduction. I know we've introduced Mark to a number of you, but you know Jim and I. Mark has been on our team for a few years, and he's just come to this meeting to observe, just to see what all the exciting things that happen in public fund boardrooms. So,
Has Mark watched the videos?
he has.
Because
Everyone.
before you come to this meeting, you have to watch the last 3 years of videos.
Mark, that's your homework for this week.
The PDFs, it looks like, and Brian, did you mind coming to see? The PDFs, when I try to share okay, so I'm gonna go to share, and they're on the desktop, and they're not showing up. Okay, I'll show you. So they're right there.
Yep.
And so, okay.
Can you save it to
Save to your documents.
Okay, yes, I can do that. Give us just a second, y'all. All right, so let me do this one.
These
Stacy, I know
panels-
you're looking through things. We went off screen here just to make hopefully the view a little bit better. I'm sure not seeing us probably does that, just or at least me. Let me just speak for myself, but we'll jump back on when we get to our section. Nice.
Thank you.
Mark's already
Earned his
making his
pay.
presence.
Yeah, already adding value at the meeting.
That's one less
Where'd the
video you
plane
have to
ticket
watch.
down right there?
Yeah.
There we go.
One less
cannot-
video to watch.
Okay. Let me go back and get it. Save all files. Double click on it. Please won't.
I
I may have to call my IT person.
just keep wondering when international is going to beat U.S.
So do we.
Has it been like over 10 years or something now?
It's had a pretty good run in the last,
The last 6 months, so the return from the end of, roughly the end of September through the end of the first quarter, EFA was up about 17.5%.
I guess the 1 year number.
Yeah, and the S&P was up about 7. So, and the reason for that is because, big reason for that is the dollar rolled over, right? As the market started expecting the Fed to take its foot off the brakes in terms of its interest rate hikes, the dollar rolled over. And when the dollar goes down, the more money we have offshore, it goes better.
I'll do whatever you say.
We would expect, for what it's worth, that trend to continue.
So it's all
Yeah, whatever.
As the Fed yesterday.
so it's all currency. It wasn't actually the companies.
Well, they did a little better too because simply because the valuations were cheaper there. So that
Oh yeah.
a bit.
yeah, the dollar added about 8%. The dollar's down.
Okay.
Nice. Here we go.
There we go.
Perfect.
was short.
Wonderful.
What's that?
That was short, is that it?
That's it. Questions?
There we go.
Hopefully this will work. That's it.
You realize you'll have to bring him to all the meetings now.
Yes.
All right.
That won't be helping your carbon footprint if you bring extra people. Start bringing more people. We'll come 2 times a year, but we'll bring 4 people.
No books twice a year.
Okay, so with all of that resolved, it's great to see everyone again. So for as bad as 2022 was, and we know we've talked about it, the struggles in the capital markets, because the Fed raising interest rates and inflation at multi-decade highs. The start of 2023 was pretty darn strong. And so the results we're going to talk about are both good on an absolute basis and then relative to the benchmark, and we'll talk about the reasons for that, the way the portfolio is positioned, all that stuff. Jim's will give his update on the market outlook as well. But this gives you a sense, right? I mean, the S&P 500 was up 7.5% in the first quarter. It was down 18 last year. So good start to the year. Non-US markets were up a similar amount. This number, 7%, driven mostly by developed markets. As you'll see below that, emerging markets struggled a bit. Still positive, but underperforming the developed world, both here in the US and overseas. Fixed income markets were strong, 3%. Last year, we were down, what were we down? 13% on bonds. Worst year in the history of the bond market. Off to a good start this year. Interesting thing about all this stuff, and there's a lot going on in the world right now, but think about in the first quarter of this year, January and February were quite strong. Then what happened in March is there started to become problems in the banking sector. You'll recall the first shoe to drop was Silicon Valley Bank. The government had to come in and take it over. that caused all sorts of volatility. But even just for a week or so, but even for the full month, equity markets were pretty good. They weren't as strong as they were in January and February, but still eked out a positive return. And then what really happened as a result of the challenges in the banking sector is that the bond market has continued to rally really, really strongly. So bonds are doing really well in light of some of the challenges in the banking sector. 3% for the first quarter, and that's continued so far into April and the early part of May. So off to a good start. Obviously a long way to go. But it's always good when you turn the page on such a challenging period like 2022 was to get the new year off on a good start. I'm not going to bore you with any of this stuff. One of the things we talked about last year and how challenging last year was, not only from a broad capital market perspective, but for the types of managers we use and the way they build their portfolios, is this issue, this thing called quality, was the absolute worst place to be last year. What does quality mean? It means companies that have strong earnings, stable earnings, growing revenues, products are in demand in the marketplace, products that you and I use on a daily basis. It's companies that have low levels of debt on their balance sheet. That factor was the reason why our portfolio underperformed our benchmark in 2022. That factor, you'll see here, the year-to-date period is the first quarter, completely reversed. And these things can happen, they can change on a dime. You can see it's the best returning factor in the broad equity markets. It's because of this that we underperformed last year, but it's because of this that when I show you, we've outperformed in the first quarter of this year. It seems common sense that, well, we want to hold those companies, right? We want to hold companies that are growing their revenues, that have low levels of debt, that have strong management teams. Those are the companies you want to own for the long run. And that's true because those kinds of companies tend to outperform. You can have periods of time, like in 2022, where it doesn't do as well, but over a long period of time, it really works. Worked in the first quarter. I'm going to turn over to Jim to talk about the outlook. I'm going to come back to the portfolio, but I just wanted to use that and sort of set the stage, give you sort of a framework as Jim talks about what our current views are. Sure.
So it's great to be with you all. We love being in person rather than over Zoom, so thanks for being here. We get a lot of questions about the stock market's performance this year, and so we want to dissect this a little bit. I think what you'll see by the end of my comments today is that our narrative really hasn't changed, and we think this bull-bear debate will play itself out in the next 3 to 6 months, but we remain pretty cautious still. So on the left here, what we're looking at, this blue line here is the S&P, and this represents these 7 stocks, really FANG plus Microsoft plus Tesla. So it's Facebook, Meta, Amazon, Apple, Netflix, Google, Microsoft, and Tesla. That's this line right here. And so what this illustrates is that while the market's up maybe 7 or 8% this year, if you extract those stocks, its average stock's up maybe 3 or 4%. And so what we call this, and here is the S&P without those 7 stocks. And so we refer to this as bad market breadth. So we prefer to see more stocks going up rather than a very concentrated bunch of stocks. And to amplify that point, we sort of look at the start of the year and then the increase in the market cap each one of these stocks is added to the S&P, and here's the remaining 490 stocks in the S&P 500. So heavily dominated by a few stocks. Not something we typically like to see. These are some of the recession indicators that we follow. Here is leading indicators. These gray bars are actual recessions. So if you look at the leading indicator in the blue line, track very tightly with an actual historical recession. So obviously signaling for us on a leading indicator basis a recession. This is manufacturing index, flashing recessionary signs. And then this is the Conference Board CEO Confidence Survey, also flashing a recession. Some of the more recent data that we look at, this is new orders for manufacturing and services. Manufacturing is the dark blue line, services is the light blue line. And when the number is above 50, the economy is expanding, and the manufacturing or service side, when it's below, it's contracting. So real-time data suggests things are still contracting. And then this is a small business capital expenditure plan. So this represents about 50% of private companies. And their CapEx plans are continuing to weaken. And some of this relates to the regional banking credit tightening that's happening, just kind of working its way through the system. So hard to see this improving anytime in the near future.
So are the numbers, particularly Jim, in the last slide, are you saying that's indicating we probably will have a recession toward the end of the year, first of next year? Is that what those numbers are saying?
They are certainly flashing recessionary warning indicators. Our view is more that we'll have a profit recession, and maybe we have a technical recession, maybe we don't. I think that's something that the bulls are hanging on to, is that we have a 3.5% unemployment rate. So that's about a 50-year low in unemployment. So that makes the Fed's job particularly difficult with that low unemployment. But as you'll see in a few minutes, what we're pretty convinced is that we're going to see a profit recession. So that's what this next slide is. So here we're looking at 2022's actual earnings. The light blue is 2023 forecast, and green is 2024. So the way we look at it is, if we look at all these recessionary indicators, if we look at our real-time data, we also have very robust internal proprietary indicators. And when we look at all that, it's very hard for us to understand how 2023 earnings can be higher than 2022. We think this is sort of a state of denial. And it's our expectation that 2023 earnings will pierce and go below where we were in 2022. And this is the fundamental barrier as to why it's hard for us to get bullish about stocks. So last year, stocks were down 20-ish%, and that was a direct result of what we refer to as multiple compression. The multiple price that investors are willing to pay for stocks decreases because interest rates went up so much. So that was sort of phase one of the reconciliation process. Phase two is earnings. And the Fed is committed to slowing down the economy. So with the slowing economy, regional banking concerns, which is a tightening of credit standards, we're pretty sure that this is, we'll be here at some point, that this number will be below. And that probably maybe 10 to 15% too high. And so that could take us down to maybe 3,500, 3,600 on the S&P. It's not cataclysmic, but our models are just too strong to support where the market is today. And because the stock market's up 7 or 8% this year, the valuation has just gone up even further. This is probably one of my favorite slides because it highlights what really happened during COVID. So this is a 10-year trend line of retail sales in business. And you can see this trend line, it tracks very tightly. Of course, it got disrupted by COVID, and then we had a massive amount of spending coming out of COVID. And so it's this era of consumption that we think is going to correct. It'll move back down towards the long-term average. And so if the consumer represents 2/3 of GDP of the economy, again, hard to imagine that this is going to sustain itself. Our view is it's going to self-correct. I think the other concerning part of this, it's certainly tied to retail sales, is this dark blue line here, and this is outstanding credit card debt, consumer debt, just on credit cards. And it's now at a new all-time high. Savings is just starting to pick up. So all of this means maybe that all of this stimulus that the government provided has been absorbed, has been spent, and now we're tapping into savings to sustain that purchasing power. And this slide just really highlights valuation. So if the economy was slowing and earnings were reset and valuations were reasonable, probably be a little bit more optimistic than we are today. But if we look at all of these historical valuation measures, price to sales, price to book, they're all on the rich side of valuation. The only one that's perhaps reasonable is the price to free cash flow. But other than that, it's pretty rich. And what this slide just shows us, this goes back to 1953, where interest rates are determines the multiple on the market, and typically where rates are today, I think the 10 years about 4%. We'd be looking at more of a 16 to 17 times than a 20 times. There's this debate in the capital markets that when the Fed pauses, it's really good for equities. So think about what happened last year. In October of last year, in March of last year, Fed funds rate was near zero. And then the Fed got concerned about inflation. And then from that point, they raised interest rates 7 times. This year, they've raised interest rates 3 times. So we've had 10 rate increases since March of last year, and that's the fastest pace that we've seen in 40 years. So that's a lot of pressure for the market to absorb in a pretty short period of time. And ultimately, what happens is things start to break, and what's breaking, of course, are the regional banks. They're getting caught with their mismatch in their assets and their liabilities. So we decided to take a look at what happens from the Fed's first rate cut. So they just indicated yesterday that there's a possible pause in their tightening campaign. And what we've discovered is we have to go all the way back to 1980 to find a period where the Fed cut rates and the market went up. The reality is it's not the pause, and it's not even the first cut. What happens is the market, it takes 195 days for the market to recover, and the average decline from the first cut is 23%. So it's not the pause, it's not even the first cut that starts to build a credible base for the equity markets. And if we look at the Fed's favorite inflation indicator, it came in at about 4.9%. The estimate was 4.7. It's just hard for us to believe that the Fed's going to start cutting it unless there's some real financial damage.
Is it sort of accurate to say, and this might be a very broad statement, that equities markets generally don't like when the Fed's doing anything. If they're raising rates, the market doesn't like it. If they're cutting rates, the market doesn't like it. They like it when it's sort of steady, rates are steady.
Because you're absolutely right, because it's predictable. If you're running a big company or running a small company and you're dealing with volatility of interest rates or capital markets or the ability to obtain a credit, what you want is consistency. You can plan around that. And when there's less consistency, volatility, it gets much, much tougher for stocks.
I guess you could...
Fed cutting rates after the first cut. So it is actually quite good for stocks. And I think this is why the market gets excited that the Fed is pausing. Because at some point, Fed cutting rates will be very good for stocks. But it's not, it takes a while after the first rate cut. It takes 195 days, 6.5 months after the first rate cut before the market tends to stabilize.
What are you hearing about liquidity based upon the issues with the regional banks? Is that beginning to dry up also?
The weak players are continued to be under. They continue to be under stress, and the challenge is they have a deposit base. Some, and I think it's important in our view, it's relatively contained, but there are banks that have a mismatch in their assets and liabilities. The uninsured deposits are leaving the bank. Right? That's the way the markets work. You know, they're not going to take, investors aren't going to take excess risk where they don't have to. So more pressure on these few of these regional banks this week in particular, yesterday and today. But in terms of the banking system, we think the banking system itself is very sound.
I guess, like, you know, also the market doesn't, the market also likes it, I guess, you know, like I guess when the government's not messing with stuff, you can make the same argument when, you know, like they like a split government so that the government can't change anything.
Yep. The market doesn't like uncertainty, and uncertainty can come from the Fed, it can come from Congress, it can come from many, many different sources. But to Jim's point, when things are stable and predictable, it's when capital markets tend to do well.
So capital markets love gridlock.
Yep.
It's hard to have a surprise one way or the other. It upsets that predictability. So I'm going to turn it back to Brian, but I just want to leave on this note that this isn't cataclysmic. This is the final cleansing of the bear market before a new bull market resumes. So if earnings have to come in, market was already down, call it 20% last year, and if earnings have to come in a little bit to continue the cleansing of the equity market, to build a very solid base going forward, we think
The earnings have been pretty good.
Yeah, that's the bull case, is earnings have been resilient. Our view is if you look at these earnings closely and you look at it cash versus GAAP, the quality of these earnings is probably the worst that we've seen since 2008. So we have a decent start to the year. Market's up 7 or 8%. Another supporting factor for the bulls. You know, our view is still 13% away from the all-time high. So, and it's had very, very narrow leadership. Doesn't give us a lot of confidence in this rally in the first quarter.
Great.
Any other questions before I turn it back to Brian?
Does the debt ceiling have anything to do with any of this? Are you going to talk about that?
We'll talk about it. The long and short of it is there'll be a lot of theater.
A lot of games being played.
Theater, great theater in Washington coming up. But that's like saying very simple analogy that I use, it's like, my son won't clean his room, so I'm going to burn down the house.
Who's being punished? Son or everybody.
Yeah, it doesn't make any sense. I mean,
In the moment, it does.
There you go. It was great. It was great.
Our view on the debt ceiling is there will be an agreement at the 11th hour.
yeah.
However, if there is ever a time where something, I was going to say out of the blue, but this really isn't out of the blue, but something is crazy as defaulting on the nation's debt were to happen, it's going to happen now. Because, there's just, time and time again, we're always surprised at how dysfunctional Washington is. It's gotten progressively worse over the years. So if there's ever a time, it's going to happen now. So what happens in the event that the country technically defaults on its debt, even though we don't think it's likely? It's actually not clear what happens, because I can see a case where let's just say they can't come to an agreement, the country defaults. What does that really mean? It means you won't get your money when you thought you were going to get it, but you'll get it back when they have an agreement. And with a default, they are forced to come up with an agreement as quickly as possible. There will be all sorts of chaos and volatility that happens in the interim, but nobody is going to be shortchanged on the money that is due to them from the federal government.
Right.
That is not at risk. There will be choppiness and volatility as a result.
I guess my question was, the market has probably already built in that an agreement will happen prior to whatever date somebody says. June 1st now, but
Yeah, I think the market is, the stock market is saying we expect an agreement to be made.
yeah.
If it doesn't, I think you're going to see a drop. The bond market, the treasury bill market, you can look at yields on treasury bills, which are very short maturity, less than a year, obligations of the federal government. Starting in June, and really, nobody really knows when this so-called X date is, when the government can't issue more debt and runs out of money. There's a spike in treasury yields in June, July, and August. So the treasury market is saying, well, we're not so sure, or at least there's a risk that it doesn't happen, and so you got to pay me more if I have treasury bonds maturing during these 3 months. So there is a little bit of a kink in the treasury bill market. Stock market is saying, don't worry about it, it'll get resolved before there's a problem.
Which either way, in reality, I mean, that's a short term, and
It is.
really has no effect on our
Well,
retirement fund. Well,
from a long-term perspective, no, but from a short-term mark, absolutely it could, because their markets could be down temporarily because the U.S. Treasury defaulted on its debt. A lot of the politicians will tell you it'll be catastrophic. It'll result in, perpetually higher interest rates for the federal government to issue bonds, because investors will say, well, you're not as good a credit quality anymore as we thought because you defaulted. I personally think that's nonsense, because I don't think, even if there's a week or 10 days where there is this agreement that's not in place and can't get your money back because the federal government doesn't have any money to pay you, they will get an agreement. I don't think there's a terribly significant, long-lasting effect from that.
right.
But just like if you put your credit card bills, if you're paying your utilities and you put those on your credit card bills, and then you decide not to pay the credit card bill because you put too much on the credit card bill, your credit score goes down.
Yeah.
And this is the serious lasting effect, and it should be taken incredibly seriously, because the last time this game was played the United States credit rating was downgraded. And so what happens is the United States cost of capital goes up implicitly going forward. And that just makes everything incrementally more expensive when the Treasury issues debt. And we have a massive amount of Treasury financings coming up.
There was, back, when was that, 2013? There was a massive amount of money that flooded into treasuries, and so actually treasury yields declined slightly, but it's it's not clear. Treasuries are often thought to be a flight to quality, right? This is the asset that everybody goes to when there's risk and concern in the markets, and so I could absolutely see if the treasury has a technical default, yields actually go down, but we won't really know until we see it. And I suspect part of it will depend on how long it takes after that point to actually get an agreement. But again, this is not what we think is going to happen. We think there will be an agreement that's made. So let's get back to the portfolio. And as we were going through these slides, I realized, and I don't know how this happened, Stacy, sorry, I probably sent you the wrong one. I have some, in the hard copies, I have some other slides in the book that are not up here. So I'll give, I've got a copy here that I can give when I get to those comments in a second. But let me just go to the portfolio here. I sort of alluded to this, right? First quarter was a good quarter. We ended last year at about $181.5 million. There's been net contributions in the first quarter of this year to $1.3 million. Investment earnings, about $11 million this year, gets us to a value at the end of the first quarter of just under $194 million. That $11 million gain from investments translates into a return in percentage terms of just over 6.5%. And for one quarter, that's quite good. And the good, in addition to having good absolute returns here, you can see our benchmark, which is just a passive representation of the way we invest our money. How much do we have in stocks and bonds and alternatives and broad indexes reflective of those asset classes? That benchmark was up 5.83%. So for the first quarter, strong absolute returns, and our return was about 1/4 percentage point higher than what our benchmark was. So quite good on both measures. We go all the way to when we first started working with the city. That goes back to the spring of 2016. Back then, it's hard to remember back then, but we started with about $88 million in assets. Net contributions through various sources of $25 million over that period of time. Investment gains of about $80 million. It translates into about a 7% return. Now this lags the benchmark a little bit. All of it is because of 2022. And at least the short-term returns are starting to get better and turn around because of that quality factor, as I talked about earlier. Here's the way our assets are allocated. Long-term targets is 70% to equities, 22% to bonds, 8% to alternatives. Alternatives, we've got a bit of real estate, we got a couple of hedge funds. Not a significant allocation there, but we think good return opportunities. And you can see how we're allocated. You know, Jim's outlook certainly gives the impression of our cautious stance on equities. And we're underweight there. We're underweight by about 5 percentage points or so. So we've positioned the portfolio to reflect this outlook that Jim walked through, one of general sort of cautiousness on equity markets. And the point is even though this underweight hurt us in the first quarter because equity markets were so strong, we still outperformed. I'm going to show you some attribution on that. We talk about the active manager results. You'll see that most of them outperformed.
And just one quick question on that. I assume like the cash, you're putting it in a money market or something?
Exactly. Cash is earning these days 4.25%, 4.5%. So it's earning something
Very different than 12 or 18 months ago when interest rates were 0. Right, so we're actually earning something on our cash these days. Here's the attribution that I referenced. We're looking at this. This is for the first quarter of this year. This is on gross of fee returns because that's the way our model does it. Fees here are pretty skinny, so there's not that big of a difference. I think the net return was 605 for us. The gross return is 613, so 8 basis point difference in fees. So if we just earned the benchmark return, it's 584. Talked about the fact that we're underweight stocks, and stocks did well. That hurt us a little bit. That took away 7 basis points from this benchmark's return. There's this thing called a sub-allocation effect, and so what does that mean? It looks not at the broad stock bond category, but within stocks in particular. Are we overweight small cap stocks versus large cap stocks? The answer to that question is yes, by the way. Are we overweight international versus US? The answer to that is yes. Both of those things hurt us a little bit because the S&P was up 7 or 8%. Small cap stocks in the US were up only 3%. So we were overweight small cap stocks. We were overweight non-US stocks, underweight large cap US stocks. That hurt us a little bit. That took away almost 45 basis points of return. All of the outperformance that was generated was from manager selection. So what does that mean? It means our managers that we picked outperformed their benchmarks. And that is where all of the excess return came from this quarter. And it goes back to the comment I made earlier, and this is one of the slides that's in the hard copies that is not in the slide up top. What we have here is the return. It's on page, sorry. No. It's on page 8. These are the returns of all of the active managers that we have in the portfolio. I'm showing first quarter returns, calendar year 2022 returns, and then the since inception return for each of those managers, again, on page 8. With the exception of one manager, which is our small cap value manager in the US, every single one of our active managers outperformed its benchmark in the first quarter. And that's markedly different from what was experienced last year, driven almost exclusively by the performance of that quality factor that I talked about earlier. Moving all the way to the far right-hand side over the since inception category, most of our managers have outperformed over the long run. This is what we would expect to see, that over long periods of time, the managers that we have in the portfolio, we have a great deal of confidence in, and over a long period of time, they've shown the ability to outperform their benchmark. Over short periods of time, that's not always going to be the case, like we experienced in 2022. But the long run results from the active management we have in the portfolio have been quite good. I'm going to, again, this isn't on, I apologize for that, on this presentation. It's in the hard copy. I want to talk a little bit about a change that we made in the portfolio subsequent to the end of the first quarter. And that relates to the way we've constructed the bond portfolio. And I've got a few slides on that starting on page 23. So we had a number of individual investments within the bond allocation. Again, keep in mind, we're targeting 22% from a long-term perspective to bonds. We're overweight a little bit, given our concerns about equity markets. But
given what happened last year, we took the opportunity at the start of this year to say, is there something different we should be doing with our fixed income portfolio? And the short answer to that question was yes. So what did we do? We simplified the structure. We had 5 specific targeted investments in the bond market. Historically, we just wanted to simplify that structure. We can get broad diversification, and we can structure a portfolio that I think is more efficient and cost-effective by streamlining and simplifying the structure, and then ultimately the idea being we have greater opportunities to generate excess returns within our bonds. So we took a fresh look at it. On page 24, here's what historically it looked like. We had, as I mentioned, 5 individual investments. The lion's share of the portfolio was invested in a separately managed account that's run by BlackRock. BlackRock is a well-known institutional fixed income manager. I think they're the largest asset manager in the world. Got a lot of scale, got a lot of resources. That's what our previous focus had been on. As a practical matter, their results have disappointed, and so we thought it was a good opportunity to take a fresh look. If you turn to page 25, what I'm showing here is the long-term returns on the fixed income portfolio. This is all ending the first quarter. You can see the results actually have been pretty good from an overall asset class perspective.
Do we have the slides up here?
No.
No. Oh, I thought it was just the one slide we missed.
No.
Okay, sorry.
The results have been actually pretty good from the asset class perspective. So, and I'm looking at, for 3 years, we were down 1.6%. Our benchmark was down 2.8%. So nobody likes to lose money, but we lost less money than the benchmark did. Over 5 years, we were up 1.5%. The benchmark was up 1%. And then since inception, we were up 1.5% versus 1%. So long-term results were good. And you might think, well, why are you changing anything if the results are good? Because we think they can be better. And that's why we're changing them. If you look at the individual components underneath the asset class return, so a lot of that return that was generated is because we did things to extend or shorten the duration of the portfolio based on our view of interest rates. It worked really well for us, but when you look at the underlying portfolio returns or each of the individual components, you'll see that the results weren't that great. And in fact, I'm focusing on BlackRock, where its return generally lagged that of the benchmark. And so this is what we were a little bit, concerned about, or if we did some different things, think we can improve even on a portfolio that has historically done pretty well.
Is our benchmark for the total bond portfolio the ag?
It is.
It's not the roll-up of the underlying. That's why.
It's the ag.
Okay.
Yep. So what did we do? It's on page 26. We went from 5 individual investments to 2. We moved out of BlackRock. We went to a portfolio that's managed by Luma Sales. And we increased our exposure to one of the existing active managers. We had in the past in the portfolio, it's double line. So 60% of our bonds right now are being managed by Luma Sales, which is another well-known institutional fixed income firm, and 40% managed by double line. Significantly streamlined. All active management, we think bonds are ripe for active management. And we think it positions us well in the future to be able to even improve on a portfolio
that did well historically. On page 27, I've got the returns just of the Luma sales portfolio over various time periods. I didn't overlay BlackRock's return, but suffice it to say that the excess returns historically that had been generated by this firm are substantially better than the ones that we had with BlackRock. So I bring this up. We have discretion to do this. I want to let you know that this took place, but I think it shines a light on something that's really sort of critical to Jim and I. When things are working, doesn't mean we're sitting by and doing nothing, because we're always questioning if we can do better. And we think we can do better. And the early reads on the bond portfolio are quite good. So this change happened in the middle of April, towards the end of April. The couple of weeks that the program's been in place, it's generated fairly significant excess returns relative to the benchmark.
So you converged 5 bond funds down to two. And how much money are we talking roughly?
47 million is the total value of the portfolio. I think there's a lot of, from a philosophical perspective, there's a lot of value in simplicity in investments, which is contrary to what you might think. I mean, everybody, this is true, capital markets and investment world is complicated and complex. But that doesn't mean your portfolio needs to reflect that. If we simplify and concentrate with firms that we have a very high degree of confidence in, we think the results will bear out over the long run. We are going to go through the same process on the equity side. We're going to relook at everything we've got, re-underwrite everything we've got, make sure that we're comfortable, and if there's changes that we want to make, we're going to make those changes. But I just want to let you know that that's going to be, between now and the next time we get together, that is going to be an analysis that happens and potentially changes made. Not going to say that for sure, but we're going to look at that.
Like double down on artisan.
Well, I don't know about that. Yeah, just look, they had a really, really tough 2022. They're up 20% this year, so it's nice to see the rebound. So I'm going to stop. I apologize for these slides. You all didn't see them, and I'm sorry for that. They weren't up here. Stacy, I sent you the wrong file. I apologize. So with that, if there's any questions, we're happy to address them.
Brian, as you reevaluate the equity side, are you expecting more consolidation there? And I ask, I'm a little concerned about the diversification we're maintaining.
Yeah. So the way we think about diversification and proliferation of individual investments within an asset class portfolio, you can get broad diversification to markets by using passive management. You don't need lots of active managers to diversify their exposures, because that becomes very costly and expensive to get that diversification. So if we have enough passive management and diversifying that way, what you can do is concentrate in a smaller number of active managers in which you have the highest degree of confidence. So I would say we are not going to sacrifice diversification, even if we simplify, because if we were to simplify, what we are really talking about is probably increasing the use of passive management, which would improve diversification, and then consolidating the number of active managers. And I'm not suggesting that that is going to be the outcome, because we actually like a lot of the active managers that we have in place. We just want to make sure it's right. What I could see happening is we may, consolidate 1 or 2 exposures. We may think about, do we want to be overweight small cap stocks like we are right now and non-US stocks, or do we want to be closer to the benchmark? So those are the decisions that I think we're going to pay particular attention to, as opposed to adding or subtracting a lot of different managers.
And part of the catalyst for this is, as I was saying, in March of last year, the Fed was keeping interest rates artificially low, near zero. Financial repression just. And when that happens, it distorts everything in the capital markets around the world. And now we went to 5 to 5.25% from near zero, 10 tightenings in a pretty short time period. So now financial conditions are tight relative to where they were. But we're moving towards a more normal environment. And what I think Brian and I are trying to express is that in this more normal environment, we need to rethink, re-underwrite everything in the portfolio to make sure it's proper in what we think is hopefully a coming normal interest rate environment where the Fed isn't playing an active role in the outcome of capital markets. So that's really the reason for us to re-underwrite all this.
Anybody else have questions, comments before we move on to John Hancock? Thank you. Thanks.
All right, well, good morning again. Should I pick it up from here?
Yep. Take it away,
All right.
Tom.
I will look to share my screen here and see if everything works here for your review. Are you guys able to see the material?
Looks good, Tom.
Yep.
All right, thank you. So let's quickly hit on just a quick look at evaluation and where we are at the close of the quarter. So I went right to the end of the 3-page document that looks at the combined retirement systems. So this is fire and police and supplemental together. If we take a look just at the last quarter's activity, we do see some improvement, which is great news. Really, that was driven by the significant contribution. The city made the actual full annual contribution in early February for around $8 million. And then, as Brian talked about, the strong market performance obviously assisted with that as well to offset that ongoing benefit payment liability that the system continues to pay out. So all in, the move of around approximately 185 million to over 196, and better news, the funded status improved close to 69%. So if we go back and look at the close of the fiscal year, you'll see that the system is up slightly as well. So we closed the fiscal year right around 68% for the combined systems. So on par and up a little bit, which is great when you factor in, what we went through during the fourth quarter. In the handout, which obviously isn't printed, but that you guys have distributed to you, also provides the breakout for the two systems. Any questions with that?
Everybody understands that?
Yeah.
All right, so we have we're in the midst of our final quarter for the fiscal year, and then hopefully we'll be able to report back on similar or higher valuation later in the year. Okay, so I'm going to transition over quickly to our quarterly update, and I do have just a couple of brief additional updates I wanted to add in. As I meet with the board on a quarterly basis, I do typically add in a little bit of flavor or reminders of how we're built as an organization to support you all. We'll also let you know on any improvements to the product offering, service support, as well as on an annual basis give a data security overview. Those are typically scheduled at different points of time. So what generally we look at this quarter is just kind of additional resources and offerings. And again, completely understand that this is primarily at this point really a system that has next to no actives, and essentially we're providing payments. But as we've mentioned in the past, now we've supported in the past, we have come out and participated and done some meetings for retirees, for individuals that do access our website. There are materials and resources there. And if it would benefit the city HR benefits groups at any point to utilize those a little bit more broadly, would love to have that conversation. And I'll just hit on a couple of those things real quick. One thing we just released a couple of weeks ago is for the past decade or so, we've done an annual participant study that looks at overall stress, financial well-being, and wellness for participant base. And this is the 9th annual year we've actually released findings. We just released them about a week and a half ago. We're getting a lot of activity with it, a lot of interest in it. I'm not going to go through the whole survey here or the results, but I did want to make you all aware of it. I can share a link if there's interest in taking a look at it. But it's a very in-depth interview for people that do agree to have a conversation with us, and it is a conversation. It's not like a multiple choice survey. And we were able to talk with over 3,800 people. And typically those conversations were somewhere between 15 and 20 minutes. So what we wanted to do was really get a sense of where people's mindsets were, how the current economy were impacting individuals, and then how that was impacting their mental health too, and their plans when they look at long-term financial savings. The other thing that was really neat that we did this year is we brought in more data. So after we talked to this sample population, we took a look to see what their activity has been with their retirement account and looked to see if we could find some correlations based on awareness and interaction and where that put them in their mindset. And it definitely did. We saw a lot of connection where folks are more engaged. They have a better feeling about what their retirement planning savings are doing for them, and we're, better comfort level. So again, happy to share this whole report. I can send it as a follow-up, but just the 3 main findings were, 1, I think to no surprise, the current environment is impacting people significantly in certain areas and in certain ways. And, we're seeing the top concerns around inflation, the total economic system, as it will, and then interest rates, and kind of in that order. And I think that's pretty significant, and it's meaningful because interest rates are what's hitting people now. Inflation is what's hitting people the most right now from day-to-day cost and having to deal with that. Inflation, a little lower of concern on people's minds, but not everyone, I think, sees the immediate impact of the rising interest rates. But obviously, and I think Jim may have talked a little bit about credit card debt and the significance that it's there, and the interest rates are definitely having a big impact. So, and then from there, just workers are looking to who their employer is for help. We've continued to see that. We see increases in that now more than ever. And then finally, to my earlier comment, tying in activity that people make, we are seeing an impact. If you can get people aware and engaged in their retirement savings or their financial wellness, it does have a positive impact, but that can be a challenge at certain points in time. And then I'll just hit this real quick. Again, we have a full participant engagement program. This is more for awareness. This is more geared towards our defined contribution, 401k, corporate universe, and some municipalities and 403b plans that are obviously active systems. But again, just to my point that there are a number of resources available online that people have access to and that the city has access to if there's a look or a need for materials. Knowing you're in the Virginia system now, I'm sure they're sharing some information, but if the city feels as though the employee base could benefit with some financial wellness information, again, happy to talk about how we could share that a little bit differently with you guys. All right, so I'm going to jump ahead if there are no questions and just give a quick update on the system themselves. All right, so Brian talked and took a look at assets. Obviously, he went into investment allocation. Let me just make this a little larger here. And this is the quarterly information I typically bring. So as a reminder, look to the far right for the current population. And as you see here at Fire and Police, we are down to 1 active right? And there are only 40 individuals that have not started to take benefit payments from us. So we're getting very close to 100, almost 100% system where we're paying out. Last quarter, and I'll make this a little bigger, I know this question came up, Mark, I believe you had asked just to see a little bit information around the different average ages in these groups here. So we report on the active population. That person now is just one. So that individual is 56 years old. But when we look at the retirees, the average age is just under 70 years old. So here it is right here, 624 retirees, about 70 years old. And then those that haven't started benefits yet, average age around 58. But because of the significant population as retirees, that average age is 68 for fire employees. All right. And then just quickly moving forward, again, this is just a quarter by quarter look at asset activity. You see the significant contribution here coming in, as I referenced earlier, and just that consistent outflow of the monthly benefit payments. Here's our one active person. And then this is, as the city has asked, just activity on a quarterly basis of what we've seen. You know, I think pretty consistent low activity. Unfortunately, there were 4 deaths reported. So benefits were ceased for 4 individuals. But, you know, I think it's important to look at the strength and the value of the benefit that the city has given. Where you see the range that folks were receiving benefits was between 30 and 47 years. So significant to those individuals, and at the same time, you know, it kind of stresses the impact of the cost of the system to the city as well.
Hey, I just have a quick question. Do public plans, can you go out to those terminated employees and cash them out, offer them lump sums? Do public plans do that?
So I think you can. I don't know if there's value and cost for your system right now to do that for the Virginia system.
We used to do that. We used to have this early retirement cash out. I think the city did it one year. I don't know if it was 2010 or 12. Maybe 10 or 10, where we offered them like a lump sum payout if they left before a certain time. We paid, they could take $5,000 or $10,000. If we paid, they could stay on our health insurance until they turned a certain age, or they could take the whole lump sum. But we've offered that, I recall, in the past, but we haven't done, just because the environment at the time, we were laying off, or we were doing furloughs and a whole bunch of stuff back then. So we did do that at one time for the city, but we haven't been in a position to feel like it was necessary now. I hope that answered your question.
When you look, typically when you look at that lump sum offering, it's geared to those individuals that aren't in pay, that are termed vested. And so again, the population in the system is pretty small.
So it's not worth it to go after 40 people?
Yeah, right.
And you might get 20?
Well, Landon, I think one of the other challenges in the public sector is those liabilities to those folks are valued, discounted at 7.25.
Yeah.
If you were to lump sum them out, my guess is you would have to do a present value at a much lower interest rate.
Mm-hmm.
So from an
the cost
economic perspective, it's probably not a good idea.
Yeah, we don't have all the drag of PBGC fees.
Yeah.
Right. Okay. And then quickly, just similar update on supplemental. So actives are down to 9 as we closed out the first quarter, 326 retirees in pay, and then only 10 vested terms here. And then if we look at the average age information, so even older population, you see your actives average 66, those in pay around 75 years old, and the term vesteds at 64. And again, because the vast population are the retirees, we're looking at average age of 74 for the entire supplemental piece. All right, and then moving through here again, the cash flow information, just showing the contribution for the supplemental. Here's your active population as we've looked at. 8 of these individuals have been with the city for over 25 years. So we know these retirements are coming soon as well. From a transactional perspective, really similar results to what we see quarter over quarter. And here we had 4 individuals that were deceased during the quarter, and benefit payments stopped. A little bit more of a range in years receiving benefits. You see we have an unknown, and this has come up from time to time because this city is certainly a very long-term system. When we took over the ongoing administration, there was just some data that wasn't available. So my guess is that this individual had been receiving benefits for a significant amount of time. All right, and then finally, I will just close with our quarterly look at expenses that we typically show. I know Brian mentioned the change in the bond portfolio strategy and gaining efficiencies. That definitely can be seen from a cost perspective as the overall investment management cost of the system went down. It's now under 30 basis points. And again, we show the breakout versus at investment management, Greystone's consultant fees, our record keeping, administrative, and consulting fees as well. And then total all in, the system, and again, has shown a decrease driven by the reduced investment of around 51, 52 basis points. And then the last 2 slides just show that breakout for the investment holdings, with the vast majority of the funds being held in the Morgan Stanley account. That really drives the overall cost of the portfolio. And I know Brian showed, and the question came up, I think this quarter, the quarter closed with a slightly higher cash holding than we typically see. Generally we're just moving cash to pay benefits. So some of that was from a timing perspective. But the good news, as Brian mentioned, is the rates that the system's earning in cash is definitely much improved from where it was. And that is everything I have this quarter. If there aren't any questions for me.
I do. At some point, I'm going to have, I know y'all are used to it by now, come in to talk to the new council, bring them up to speed. I guess more so just finding out what's your availability and when do you foresee being able to do that. Our budget, we'll adopt the budget on Tuesday. So sometime probably in the summer or in the fall, it's just, I'll yield to you to tell me what's good for you all.
Well, we're happy to be here whenever convenient for council. I think historically we've done it in early November, if I remember right.
Right.
You may want to wait until after the plan year. So anytime, and Tom, I don't know when you have, I don't recall when you had your valuation done.
Yeah, so we're targeting to do that in the November meeting. I think it's the first week of November now. And typically we're wrapping that up right before that meeting.
We're happy to be with council before November, but that's when the last plan year's valuation would be done.
Right, I remember that being a question.
Or 2.
Or 50. And of course, I'm watching the performance. It looks great. I'm so happy. I know y'all have been very supportive, and with everything that's going on, you're still striving to be the best division we have for retirement. I love y'all. You're so excited about what you do. You love what you do, and it shows. But again, if I gotta take a beat down, so yeah.
You don't have to do it alone.
We're there for you.
You are. I love that. You are. You can see my tears. So I just want to
let us know if we need to do something earlier than that as well.
Yeah. So far, and I know one of the things that they've approved is the $1,500 for the one-time supplement or stipend. And then we have another thing I have to get with insurance for HRA, but they've approved that in the budget. So that's gonna be there, at least the 1.5, I mean, that's how much it costs, but the 1,500. But I don't, they're not sure. We got 2 new people who really are trying to understand and learn. So I think by November, that would kind of get them caught up and try to figure out what they need to know about the portfolio. I love that it's performing. I'm really hopeful that it will continue to perform this way, so that because I know one of the hot topics is they've been pressuring them about a COLA increase. And again, I can't do that until we're at 80% based on what our ordinance says. So just to keep everybody mindful of that. So,
Mimi, I'll just offer this up to you, and you can take us up on it or not. But if there are a handful of new council members that are trying to get their arms around this, we're more than happy the next time This is why I said you could take us up on this or not. But we're more than happy to have a one-off conversation with them to help them understand.
That's fair.
Whatever you need.
I
We'll
appreciate
be
that.
there.
I appreciate that.
Mimi, just checking back to the 1,500, was there a goal to try to do that for June or July?
It'll be in fiscal year 24 budget. So sometime we'll just, I guess with what we do with you, once they approve it, we'll talk to you and figure out what's the best time to do that for them. I didn't give them an exact date of when we would be able to do it, but just know it'll be during fiscal year 24. I guess Mark will tell me when he wants his money.
Does this come out of the plan assets?
No, we take it out of our, we budget for it. And
You contribute and then it gets paid out of the plan?
No.
No.
So
It's just a separate.
it doesn't go through the actuarial or funding
Right.
process.
Which is
Rivers Casino.
Yeah.
Yeah, the city essentially uses the structure that we have set up as a paying mechanism.
Just dispersed in.
It
Yeah.
doesn't flow through the plan.
Yeah, and what we always kind of say is, we could be investing that back into the system. But again, I agreed, I proposed it this year for all of the reasons we talked about. The current environment, inflation, they don't get a COLA increase. We have people who are in need, and I just, felt like to have those dollars in their hand to be able to do what they need to do with it would be just the right thing to do. I think it's more of that. Again, we have VRS, they get COLA increases, but because the performance of this portfolio, they're not there yet. So they don't get the COLA increases like they used to. So we just wanted to do something to let them know we care, we understand, we want to do something for you.
Do only the retirees get the money?
In this
Like the
group,
actives and the term vested don't get anything?
if you're active, no, because you're still getting a check.
Right.
But if you're retired, yes.
Interesting.
Yeah, and historically, the terms not in pay, I don't believe have received it. But, we can support whatever the city wants to do.
Nope. That'll be a no. So I appreciate, and unfortunately, I have Davenport who's out waiting for me in the hallway. So thank you guys. I have to step out, but again, great work always. I really appreciate you, and you're always there. I guess the actuarial report, we have our audit starting soon, so I'll be bugging Andre.
He's gone.
He's oh, this is the new Andre?
That's the new
New Andre.
Hey, new Andre. I'll be bugging you then.
I look forward to it.
Poor guy.
You
You don't
don't know.
I have so much attention to give you. But definitely we'll be in communication because our actuarial study, we have to submit that to the auditors. So, thank you all, and I'll see you again. We have National Day of Prayer today, so I'll be dragging Stacy out of here soon.
Yes.
Have a good one, guys. Be safe on your travel.
Thank you.
Does that mean we do or do not get $1,500? Huh?
Board members get it too.
Mr. Holly wants it.
I think the only, I don't know if we actually covered this or not, but it's under John Hancock's section, the review of retirement / deaths. I guess that was covered when you, the last couple pages.
Correct.
So I think if no one else has any questions, we can adjourn. Thank you very much, Tom, John, Colette.
Thank you, everybody.
Bye, guys.
See everyone.
See you.
Thank you.
Thanks for having us.
Thanks
All
for
right.
joining
Whether
us.
it's the police or fire.
Meeting adjourned.